In mid-2009, Spread Networks was undertaking a $300 million project to run a fiber optic cable from Chicago to New Jersey. The goal was to lay this cable as straight as possible, which meant it cut through everything in its way. Rivers, mountains, you name it. The goal was to reduce the speed of data transmission from 17 milliseconds to 14 milliseconds. The primary clients of Spread Networks are high-frequency trading firms. The average human reaction time is 250 milliseconds. This $300 million project was going to shed 3 milliseconds. Needless to say, this bump in internet speed was not meant for humans. Now, this would mean that it could take you 250 milliseconds to hit that subscribe button and another 250 milliseconds to hit that like button, and YouTube would show me a lot of love for it. So what's in New Jersey? New Jersey holds data centers for many of the major stock exchanges in the US. And having your finger on the pulse of these servers humming away trillions of dollars worth of trades every day, getting first-hand information before everybody else can make it or break it if you're an HFT firm. How? Okay, let's start from the top. What does a high-frequency trading firm do? They profit off of arbitrage. Trigger warning, this may make you a wee little mad. Let's say you're an investor and you're trying to buy shares of Apple. You'll have to do that through a brokerage, and the brokerage will have to buy these shares off of the public exchanges. And there are many exchanges that the brokerage has the option to buy stocks from. The brokerage, being your agent in the deal, sets a highest price that they are willing to pay for each share of Apple. Each of these exchanges will have sellers who will want to sell their shares of Apple at slightly different prices. There will, therefore, be a lowest price that sellers will be willing to sell a share of Apple for. The difference between the buyer's highest price and the seller's minimum sell price is called the bid-ask spread. With me so far? Cool. So your broker tries to fill that order by finding the best price from one of these exchanges. Enter an HFT firm. These HFT firms have such mind-bogglingly fast internet connections that they can see the maximum price you're willing to pay for your shares as your order comes in, buy those shares from the lowest bidding seller, and sell them to you at a slightly higher price, all within the bid-ask spread. Think about it like this. As a high-frequency trading firm, you're essentially the Flash, running circles around a bunch of 100-year-old Galapagos tortoises as they're trying to make trades. Say you were willing to pay up to $150.5 per share, and the lowest bidder was willing to sell a share to your broker for $150.2. An HFT firm would swoop in, buy those shares at $150.2 from the lowest bidder, and sell them to your broker at $150.4. Arbitrage! It's like you're going grocery shopping, but by the time you're at the store, an HFT firm is already past the checkout line, groceries all bagged up, and ready for you to pick up. Okay. Eggs, milk, Cocoa Puffs. What else? CBD drink, horse tranquilizer. Can't forget that. Yeah, that should be it. As long as I don't spend more than $100, I'm good. Here's your grocery. Okay, this is exactly what I wanted. How did you know that? That'll be $100. Hang on, who told you my budget? Next. Okay, so you're losing pennies per share. No big deal, right? Here's where it gets worthwhile for HFTs. Take managed funds, for example, like pension funds or ETFs. They aren't trading in one or two shares of a stock. They're putting in orders that are worth hundreds of thousands of shares. And ETFs make their money by going after big fish orders like those. Those pennies stack up fast, and HFTs make obscene amounts of money by arbitraging the differences for these share prices between different exchanges and different parties. But how do these HFT firms accomplish this? First off, if you're imagining a busy trading floor where middle-aged businessmen in business suits are shouting over telephones and pumping their fists at every order that goes through, you'd be dead wrong. It's all algorithmic. Ice-cold CPU cores running millions of calculations in nanoseconds to decide which trades to place and then automatically placing them. All running on information that travels close to the speed of light from the data centers of these exchanges to these computers. There is a lot more to HFTs, and I plan to make a few videos in the future about the crazy lengths to which they go to shave off a few milliseconds here and there. So subscribe to stay tuned. Until then, Train your reflexes and stay sharp.